Rohan.
Good evening to all. Namaskar. I, CA Rohan Sharma, welcome you all in today's webinar organized by Taxation Audit's Quality Review Board on the important topic of understanding practical issues of ICDS. I would like to introduce CA Sanjay Kumar Agrawal ji, Chairman of Taxation Audit's Quality Review Board of ICI. CA Sanjay Agrawal sir is Central Council member of the Institute of Chartered Accountants of India. Consequent to the election to the Central Council first in 2010 and re-elected in 2013, 2016 and 2022, he had the opportunity of serving almost all the standing, non-standing and other committees of the Central Council constituted since 2010-11 as chairman, vice chairman and member. He is presently chairman of committee for members in entrepreneurship and public services, chairman of committee for aggregation of CA firms, and chairman of taxation audits quality review board. He was also Northern India Region Council member of ICI 2004 to 2007, chairman 2004 to 2005, executive member 2005 to 2006, and treasurer 2006 to 2007. Now, I would like to introduce CA Dr. Anuj Goyal ji, Vice Chairman of Taxation Audits Quality Review Board. CA Anuj Goyal ji is presently 6 times Central Council member ICAI since 2004, Chairman Professional Skills Enrichment Committee ICAI, Chairman Ethical Standards Board ICAI, Convener Publication and CDS Directorate ICAI, Vice Chairman Sustainability Reporting Standards Board, and Vice Chairman Taxation Audits Quality Review Board. He had also been members of various non-standing committees of ICI. He has also been engaged with ICSI and ICMAI. Now, I would like to request CA Anuj Goyal ji, Vice Chairman of TAQRB of ICI, to deliver welcome address to the participants. Sir, over to you.
Thank you very much. I'm really very happy that we are having this wonderful webinar on understanding practical issues of ICDs in the tax audit linked with Inds As. And I am at Rishikesh at the bank of Holy Ganga River. And I am really very happy that from Rishikesh, from the Ganga's that I am live with all of you. I welcome Sri Sanjay Agrawal ji, our Honorable Chairman, Dynamic Chairman of Taxation Audit Quality Review Board, and we are having very, very prominent resource persons today. And friends, I think the way Sanjay Agrawal ji is trying his level best to see that how we can really do something very, very concrete for the cause of the profession, for the cause of the society, something really, really great. We are having Mr. Sharma, our honorable guest speaker, and of course, we are having the presence of Karthik Jindal ji, our honorable guest speaker, and CA Rohan Sharma ji. So a very, very big round of applause to both the our honorable resource persons. And CA Rohan Sharma ji and Karthik Jindal ji is going to take very, very important topic for all of us. And friends, the way Sanjay Agrawal ji is leading this Taxation Audit Quality Review Board to see that how we can improve the quality as per the expectations of the society, as per the expectations of the regulators, as per the expectations of the trade and industry. I think something really, really very great. And I'm quite confident that with the help and support of the great resource persons like Rohan Sharma ji and Karthik Jindal ji, all of us will be more richer in our knowledge on this very, very important topic, understanding practical issues of ICDs in tax audit linked with Inds As. And we are trying our level best to see that how, with the help and support of the best of the resource persons like Rohan Sharma ji and Karthik Jindal ji, we can try to handle and support the best of the chartered accountants in the best possible manner to improve the quality of the tax audit undertaken by the members of ICI. And friends, as you may know, ICDS was introduced to standardize accounting policies for tax purposes, aiming to reduce differences in tax outcomes. However, implementing ICDS has not been without its challenges, especially when it needs to be aligned with the more advanced Inds As framework. One of the main challenges we face is the adjustment and compliance burden on companies. The differences in how revenue is recognized, inventory is valued, and foreign exchange functions are handled under these two frameworks often lead to significant adjustments. This not only makes the audit process more complex, but also requires a solid understanding of both tax laws and accounting standards. In conclusion, while the alignment of ICDS with Inds As presents challenges, it also offers us a chance to enhance our expertise and provide greater value to our clients. So without further delay, I would like to wrap up my remarks, and I'm confident that this session will be incredibly informative and valuable for all of us. Thank you very much. And I will request C. Sanjay Agrawal, our Honorable Chairman of the Taxation Audit Quality Review Board, for his words of wisdom, please. Over to C. Sanjay Agrawal.
Thank you, Anuj Bhai. First of all, my namaskar to everyone and happy learning. But now I am feeling jealous because I am finding Anuj Bhai is there in the council meeting and starting the tone from the Rishikesh, Ma Gange from there. And I am missing you, sir, all of you. Let me welcome all of you in this webinar. This webinar, actually, when we designed, it was only for the reviewer, those who are quality reviewer with the Taxation Audit Quality Review Board. As friends, you all know that Taxation Audit Quality Review Board is for the purpose of checking our audits which we are choosing, and at present we are choosing only out of listed. And this year, with our Dr. Anuj Goel full participation, approximately 123 the companies, of which my tax reviewers will see to it, and they will give the report to group. The second layer of the group will give the report to the board, and board will look into all those things which are there, and on the basis of which the advisory is caution or some amendment is required in the audit report, or the something is there to improve it. So we bring us our publications also, the common mistakes, and this committee is absolutely on the same lines on which our financial review board, that is FRRB, is working. This year also we have launched one software. Now the reports in the physical form will not be given to the reviewer or to the group. The entire process is being automatized, and they have to do on the screen base. So these are the few things which we are trying to do it. The another thing, friends, when we were looking to the reports which have been done in the last year and the board was reviewing, let me tell you that each report takes around 2 hours to 3 hours to discuss, and then office has to also visit. And I'm also, you can say, recognizing or giving the acknowledgement of the TAQRB committee officials, those who are also listening to this particular webinar, and they have been requested to be present over there. That the balance sheet which we are examining as an annual report, they are based on Inds As. In not only one case, but in all the cases, because we are picking up only the listed companies or the larger companies on which the Inds As is applicable. We are not yet picking up the smaller company, so smaller auditors should not be afraid of us. So this particular webinar is only for the specific target audience, those who are practicing in the Inds As, IFRS, etc. So the financials are based on fair value method. However, the Income Tax Act, the computation which is being made is on historical cost method, as well as most of the clauses which are reported in 3CD and in 3CA or 3CB, wherever the reports are required. In fact, it is to be only in 3CA. The auditor has to also give somewhere some reporting that how the financials are not on the basis of the fair value. The financials which he is representing in the audit are based on the historical cost. The second point is this: understanding the ICDS, the Income Computation Disclosure Standard. Now, most of the ICDS have been incorporated in the Act. For example, all those who are dealing in derivative, the companies are also dealing in derivative. So, Section 36(1)(18) is about how to recognize the M2M. The ICDS talks about how to recognize so many things. There are so many amendments which have been made in 43CA also. So the none other than the faculty, the young and dynamic, ranked 9, and my son like Karthik Jindal, I could find him that he can make a balancing between the ICDS, the Inds As. The few of the minutes, the Karthik, if you would like, you should devote on why the Inds As will apply on a particular entity for which you are doing a tax audit. And if suppose it is the Inds As which is applying to it because it is eligible, but the financial which have been given by the auditor, even if it is by some other auditor, then in that case where the qualification is required to be given, and my taxation audit reviewer should make use of those things and how to read those documents. It is an important thing which we need to see to it. And similarly, I'm confident that this will be a webinar which will be available in future also. And the about Karthik Jindal, though Rohan will take care of the introducing the speaker. Let me introduce the Rohan also, that the entire webinar will be handled by you, and Karthik will be explaining the things. Please keep at least 15 to 20 minutes of the last end of the seminar for the purpose of the question answers which are likely to come. As I know that since this is not on the Zoom platform, this is on the participation, this is webinar. So this is not a meeting mode. So the members will be putting their queries, and office will take care. The office will do it. And the Rohan, if you could do it, that job office will forward to you on your WhatsApp or wherever you want, or it can be seen in the chat box by the panelists also. So please keep at least, because I always say that whenever if you ask any cashier in a bank, which is the real great moment is in life, so he always says at the end of the day, when my cash tallies with my cash book. So I takes this endeavor that the cash book of my speaker should tally with the all answers to be given. And even if one answer is not given, in that case, it means the cash book is not tallied. So with this background, I have full confidence because I have seen him so taking so much pain. And today is the first session with the TAQRB of Karthik Jindal with us as a on virtual platform. Thank you very much. Thanks a lot for joining here, and we will be doing all your queries to be answered by us. Thank you very much.
Thank you.
Sorry,
Thank
over
you,
to
CA.
Rohan. Sorry, over to Rohan.
Thank you, CA Sanjay Agrawal, sir, for your words of wisdom, which will enlighten the participants and help them in conducting tax audit in more effective manner. I would like to now introduce the participants of this webinar to our keynote speaker, CA Karthik Jindal ji. CA Karthik Jinjal ji has been a keynote speaker in various at various forums before various seminars, webinars, which are being held by ICAI, Institute of Chartered Accountants of India. CA Karthik Jindal ji, over to you, sir. Please, the floor is all yours,
Thank you,
and we
Rohan.
are eagerly waiting to listen to your words of wisdom. Over to you, sir.
Thank you, Rohan, sir, the moderator of today's program organized by the Taxation Auditing Quality Review Board, TAQRB. I really like to thank CA Sanjay Kumar Agarwal, sir, my like father, the chairman of the Taxation Auditing Quality Review Board, and the C. Anuj Goyal, sir, the vice chairman of the Taxation Auditing Quality Review Board, and also all the team members, secretaries, and all the secretariat department for giving me this wonderful opportunity on the very important hot burning topic is understanding practical issues of ICDS, income computation disclosure standards, ICDS, in the line with the Ind AS. Respected member, first of all, a very good evening. I have a total time of 1 hour and 25 minutes approximately, and I will take care your each and every minute will be fruitful. Member, first of all, I would like to say that with very sorrow heart, I want to tell you one fact that we are very non-compliant in the doing the compliance of the ICDS. We just taken ICDS as a matter of fact that, sir, what will happen if ICDS will not compliant? I will see many of the companies. I have seen number of hundreds of companies where the figure of ICDS reporting is nil in the return of income and as well as the form 3CD, and the comment as an auditor we make in the form 3CA is also making the non-compliance. ICDS calculation cannot be possible without the understanding of the relevant financial reporting framework. Members, if we can't understand INDS, if we can't understand accounting standard, we cannot comply even a single requirement of the ICDS, because ICDS, how the government is making ICDS? Government is making ICDS only of the basis of the financial reporting framework, that is INDS and accounting standards. We need to comply with the ICDS. As I always said, accounting standards is the mother of all standards, but we are deviating from the standards. Let me telling you about the brief history of the ICDS. ICDS is introduced by the Government of India on 31st March 2015. Sir, 31st March 2015, the central government has made an announcement under section 145 subsection 2, 145(2) to make the compliant for the what are the ICDS? What is the applicability of the ICDS? Firstly, I will tell you about the section 145 of the Income Tax Act. I'm opening my screen. This is my screen, sir. I'm opening. See, sir, Income Tax Act 1961. Section 145 says that income chargeable under the head PGBP. Members, please clear. Income chargeable under the head PGBP or income from other sources shall, subject to the provision of subsection 2, be computed in accordance with either cash or mercantile system of accounting regularly employed by the assessee. Now the section 145(2) says the central government may notify in the official gazette from time to time the income computation disclosure standard to be followed by any class of assessee or in respect of any class of income. Member have been asked me numerous questions, sir. What will happen if we do not comply with the ICDS? Members, please remember, if the assessing officer is not satisfied, about the completeness of the accounts of the assessee, or the method of accounting which is regularly employed by the assessee is not followed, or if the assessing officer find that the income from PGBP and IFOS, income from other sources, is not computed as per ICDS, they may take our best judgment assessment as per section 144 of the Income Tax Act 1961, sir. First off is that, sir, where can ICDS apply? We have two types of entity. One is corporate entity, second is non-corporate entity. Sir, we initially think that ICDS is applicable only on the corporate entity, but we are thinking wrong. Section 145 clearly say, what they say? What they say? Income chargeable under the head PGBP or IFOS shall be computed subject to the provision of the ICDS according to the cash method of accounting, either mercantile basis of accounting, which is regularly employed by the SSC, and Income Tax Act define this act as a person. Person includes individual. Person include HUF. Right? Person include individual. Person include HUF. Person include AOP. Person include firm. Person include LLP, company, BOI, artificial person. Sir, now I am telling you that ICDS is applicable to each and every entity. Does not matter that we are corporate or we are non-corporate, ICDS will be applicable to every entity. Compulsory, mandatory, sir. Now, sir, I am sharing you my screen again. This is my section, sir. The section says that the central government may notify. Sir, is government has been notified the standard? Yes, sir, government has notified the standard. I am showing you the standard, sir. See, sir. What does this say? Government of India, MOF, Department of Revenue, Central Board of Direct Taxes, notification dated 29 September 2016. What this notification says that in exercise of power confirmed by subsection 2 of section 145, notify the income computation disclosure standard as specified in the annexure to this notification to be followed by all assessee, including corporates, including non-corporates, including LLP, including partnership firm, including trust, including society. We have only two exemptions, sir. We have only two exemptions. Second is the other than the individual or HUF family who is not required to get its account of the previous year audited in accordance with the provision of section 44 AB of the SAD Act following mercantile system of accounting, sir. That means that, sir, ICDS will be applicable to all assessee following mercantile system of accounting. That means, sir, in shortcut, if your assessee, you are a quality reviewer, you must need to think that if in the form 3CD, you will find that the account is basis on the cash basis of accounting. That means ICDS will not applicable. ICDS will only applicable when the assessee employed a mercantile system of the accounting, sir. Also, ICDS only give two exemptions, sir. Also very important, sir. ICDS only give two exemptions, and it will be applicable from assessment year 17-18 onwards. Means from 1st April 2016, the ICDS. How many number of ICDS? There are 10 number of ICDS which is mandatory applicable from 1st April 2016. Now we are having the 12th of August 2024. Means, sir, more than 8 years has been elapsed. But the applicability of the ICDS and the reporting of the ICDS with the disclosure requirement is quite challengeable for the auditor as well as the preparers as well as the checkers, sir. Because, sir, ICDS is not easy. It is very complex. It is very understandable. It is very technical, sir. From 1st April 2016, sir, only ICDS gave two exemption that only individual or HUF only individual or HUF which does not require the tax audit, which does not require the tax audit, even though they are following the mercantile system of accounting, even though they are following the mercantile system of accounting, if individual or HUF does not get its account audited under section 44AB, the ICDS provision will not applicable. Otherwise, in every case, sir, in case of LLP, in case of firm, in case of company, in case of trust, in case of society, if tax audit is not there, then also ICDS will applicable, provided the mercantile system of accounting shall be followed, sir. Now, sir, sir, please think, what is ICDS? ICDS means income which is computed as per PGBP, and IFOS will governed by the ICDS requirement. That also means, sir, if we have income from the salary, if we have income from the house HP, and if we have the income from the capital gains, ICDS requirement does not apply. It is only applicable to income when we compute from the PGBP and when we compute from the income from other sources. Only two head of income, sir. Only two head of income. This is take as a class of income. Now, sir, second question is that, sir, while calculating the turnover, sir, if I'm talking about the ICDS, it is notified under section 145, under section 145 to some FAQs from the ICDS, sir. Sir, is ICDS is applicable on presumptive taxation basis? Sir, I am not doing audited. I am not doing audited under section 44AB of the Income Tax Act. But sir, I am opting the presumptive scheme 44AD, 44ADA, 44 anything means presumptive taxation. Can ICDS is applicable, sir? Member, please think. क्या presumptive taxation के अंदर ICDS apply होगा? Sir, absolutely ICDS will apply because कोई exemption नहीं है, because we are calculating income because we calculate income from the PGBP as per ICDS for getting the number of the income, for getting the number of the gross receipt, for getting the number of the turnover. We need to adherence the requirement of the ICDS and other provisions of the act. So one thing is very, very clear, sir. For calculating the presumptive taxation income, the ICDS need to be followed for the calculation of the sale, for the calculation of the turnover. Second, sir, is ICDS is applicable to the non-resident? Can ICDS is applicable to the non-resident? Sir, absolutely, sir. Yes, ICDS will applicable to the non-resident. Income tax department CBDT creates no differences between the resident as well as the non-resident. So ICDS will applicable to non-residents. But sir, one thing is very important, sir. If there is a contrary between the ICDS, if there is a contrary between the ICDS and the Income Tax Act or the Income Tax Rule, then the Income Tax Act or the Income Tax Rule will prevail. That means ICDS requirement will not be applicable on that case. If there is any contrary to the Income Tax Rule, to the Income Tax Act 1961, then the Income Tax Act will prevail. The ICDS requirement will not be prevail, sir. Also, sir, for example, sir, some members start debating one thing. Sir, ICDS is applicable from 1st April 2016. Sir, there might be many cases, many Supreme Court judgment, many High Court judgment that we taken as a base prior to the 1st April 2016. Very, very, very important, sir. Prior to the 1st April 2016, there are thousands of High Court judgment, there are thousands of Supreme Court judgment on what basis we are computing our income, that which tax will be paid. Sir, what will happen to those judicial pronouncements, sir? What will happen to those? Members, please let me very, very clear with you. For prior to the 1st April 2016, if there is any judgment by the Supreme Court, if there is any judgment by the High Court, which creates a confusion, which takes a different view according to the ICDS, then the requirement of the ICDS will prevail. Yes. But there is a one exception, sir. There is one exception. If there is any judgment, if there is any High Court, Supreme Court judgment which prescribe the basis of the law, which prescribe the fundamental principle, which define the terms, then that judgment will prevail over the ICDS, sir. This is the brief background of the act, sir. This is the brief systematic things of the act. And one thing we need to remember, while computing the income from the PGBP, while computing the income from the PGBP or IFOS, section 145A will also need to be considered, sir. Very, very important section, sir. Very, very important section, sir. This is very important, sir. 145A, you can note 145A of the Income Tax Act 1961. Most important section in the history of income tax, sir. Also, sir, one thing, sir. Sir, while calculating the limit of the tax audit, sir, while calculating the limit of the tax audit, is the requirement of the ICDS still be there? Sir, you have initially told me, Karthik sir, you have initially told me that ICDS will not applicable in case when there is an individual or HUF. When there is individual or HUF, when there is individual or HUF which is not required to get their account audited according to section 44AB. But please remember, sir, while calculating the limit for the turnover, for the sale, we need to follow the requirement of the ICDS. Yes, sir, yes. While calculating the limit for the applicability of the tax audit for the calculation of the turnover, ICDS will be required to be followed, sir. I'm simply giving you very simple examples, sir. Very simple example, sir. Please get me. Sir, if we sell ₹100 amount to any third person, sir, हमने 100 रुपए का सामान बेचा, and it also includes the GST 18%, total amount is 118 rupees. Members, can you please tell me, while making the balance sheet, while making the profit and loss account according to the Indian accounting standard, according to Ind AS of the companies, how many amount of sale will be there? Number, sir, number क्या होगा as per the P&L? Sir, absolutely 100 rupees. Sir, absolutely 100 rupees, sir. Because, sir, we are making the accounts according to the Companies Act 2013. We are dealing with the Ind AS. Ind AS is only applicable to the companies as right on them. Ind AS is only applicable to the corporate entities. What does the mean of corporate entities? Corporate entity means companies which is incorporated under the Companies Act, either 2013, either 1956. Ind AS will only applicable to that company. Sir, is every company is required to follow Ind AS? No. There are certain companies which is required to follow Indian accounting standard for their accounts. One is, sir, all listed companies, sir. All listed companies. If that quality reviewer is if the quality reviewer is seeing the financial statement, if they seen that the company shall require to follow Ind AS, but the financial statement is prepared according to the accounting standard, they need to qualify the report 100%, sir. They need to qualify the report, because the financial reporting framework is not at all valid. It is invalid. It is very big non-compliant. Second, sir, unlisted companies which is having net worth, not sale, not borrowing, not loans, not turnover. I'm say unlisted company having net worth more than 250 crore or more. If any unlisted company is having a net worth of 250 CR or more, then the Ind AS is applicable, right? And third is very, very important, that if Ind AS is applicable to any one company, If Inds is applicable to any one company, then all the subsidiary, all the holding company, all the associate company, all the joint venture company shall require to comply with the requirement of the Inds. Sir, you need to see very carefully as a tax auditor, as a quality reviewer. You might see the financial statement of any subsidiary company or any holding company. Sir, you need to see the applicability of the Inds to the holding company. If suppose by chance holding company complying with the requirement of the Inds and the financial statement of the subsidiary is preparing according to the accounting standard, that is also a very big non-compliance, sir. So we need to understand the applicability of the Inds. Sir, if any company is not required to prepare Inds, then what we can do, sir? Then the accounting standard will applicable, AS will applicable onto that date, sir. I am seeing the example, sir, that we have sale rupees 100 including GST 18%. Total amount that we will receive from the customer is 118. But the amount that will be shown in the revenue from operation is rupees 100. This is as per the accounting standard. This is as per the Inds, sir. But and suppose that you need to prepare the profit and loss account, sir. You need to prepare the profit and loss account as per Income Tax Act. Sir, you need to prepare the profit and loss account as per Income Tax Act 1961. What amount will be there as your sale, as your revenue, sir? Sir, 100 rupees na, sir. Sir, this is very simple, sir. What can you doing, sir? This only rupees 100, sir. No, sir. It will be 118. How can you say that? Absolutely, sir. Absolutely. Please read the section again, sir. Please read the section again, sir. See, sir, very important, sir. Income chargeable under the head PGBP, subsection 2. Now, 145A method of accounting in certain cases, sir. For the purpose of determining the income chargeable under the PGBP for calculation of section 145 income, this income chargeable under the PGBP, we need to take consideration of the section 145A also. We need to take consideration of the section 145A also, and also the consideration of section 145(2), which deals about the ICDS. So he's showing that first point. Second point is that the valuation of the purchase. Sir, the valuation of the purchase and the sale of goods or services and inventory also means they have taken the purchase, they have taken the sale means turnover, and have taken the inventory means stock, shall be adjusted to include the any amount of tax, duty, cess or fees by whichever name called actually paid or incurred by the assessee to bring the goods to their place of its location and condition as on date of valuation. Sir, this is very big issue, sir. In the accounting standard, sir, here what the differences will start. Sir, here will the differences will start as per ICDS and as per Inds. The ICDS will applicable in case of inventory is ICDS 2 inventory. In case of ICDS related to inventory, the ICDS is ICDS 2 inventory. And in case of the financial statement, which is there as per Inds, the Inds 2 will apply inventory, sir. What does Inds 2 say, sir? The Inds 2 says, while calculating the cost of the inventory, sir, while calculating the cost of the inventory, the cost shall not include the taxes which is subsequently refundable by the taxation authority. Means if we have the input ITC available there, we cannot add as a cost to the inventory, sir, but as according to the ICDS 2 inventory and according to section 145A, the amount of GST, the amount of excise if applicable, the amount of import duty, the amount of custom, the amount of any tax shall be included as a part of the inventory, sir. Sir, then how we can say that the inventory is matched with the financial statement? Sir, we often see this is the form 3, this is the form 3CD. The relevant clause is clause number 13. Method of accounting employed in the previous year. For example, mercantile, we have said that. Whether we have changed the accounting, sir? No, we have not changed that accounting. This is form 3CD. Point number A simple, point number B very simple, point number C more simple, because we have not changed the effective zero. The point is that point number D, this is the game changer, sir, in the tax audit report, sir. Form 3CD. And also when you see the computation, the return of income, in the schema they have also inserted that clause, that column, sir. Whether any adjustment is required to be made to the profit or loss for complying with the provision of the ICDS standard notified under section 145(2). So this is the things. ICDS 1 accounting policies, ICDS 2 valuation of inventory, ICDS 3 construction contract, ICDS 4 revenue recognition, ICDS 5 tangible fixed asset, ICDS 6 changes in foreign exchange rate, ICDS 7 government grant, ICDS 8 securities, ICDS 9 borrowing cost, and ICDS 10 provision contingent liability and contingent asset. You, sir, initially when the government introduced the ICDS, there are 12 number of ICDS. There are 12 number of ICDS, but finally after due deliberation, after the expert committee's recommendation, only 10 ICDS is issued, and the requirement of the most of the ICDS is incorporated as a part of the act. When the ICDS is issued, as chairman of the TK Taxation Audit Quality Review Board say that when the ICDS is introduced, there are significant amendment made in the finance bill 2015, sir. More than 20 to 25 requirement has been changed of the finance bill 2015 in the act, which suits the changes according to the ICDS. But so there are ample of the requirement, there are number of requirement which are there in the ICDS, but they are contrary with the Income Tax Act. I will also take care of that fact, sir. Please remember, sir, my topic is only ICDS. If there is any of the requirement which is different from the ICDS of the Income Tax Act, the requirement of the Income Tax Act or income tax rule will prevail over the ICDS, sir. Now, sir, what will happen, sir? Section 145 says the amount of purchase, the amount of sale, the amount of inventory shall be inclusive of the tax. क्या बात है सर? Really great, sir. क्या बात कर रहे हो सर? Sir, while calculating the limit of the tax audit, sir, turnover has not been defined under the Income Tax Act, sir. Sales has not been defined under the Income Tax Act, sir. But the section has been defined, sir, 145A. Sir, while calculating the limit of the tax audit, have you ever noticed, have you ever taken the sale as a inclusive of the tax? We cannot take, sir. We cannot take, sir. Why, sir? This is the big issue. This is the big challengeable issue which need to be taken into account by the department and as well as the ICAI also in the guidance note on tax audit, which is revised by the ICAI in 2022 and in the 2023. The requirement of this is still under the umbrella. There is no proper clarity on the concept of the section 145A of the Income Tax Act. So while calculating the number of the sale, while calculating the number of the purchase, and while calculating the number of the inventory, so as per ICDS strictly, there is a need to add the amount of the GST into that number, sir. But sir, we are maintaining the books of accounts. As per the relevant Financial reporting framework, sir. There is a ample solution to one fact, sir. There is a ample solution to one fact, sir. This is ICDS, sir. What is the ICDS say? The preamble of the ICDS. This is say the income computation disclosure standard is applicable for computation of income only. They are not for the purpose for the maintenance of books of accounts, sir. Please remember, let me very clear with you. For maintaining the books of account, you have not हमको ICDS के requirements को follow नहीं करना, but for calculation of the income from the PGBP and IFS income from other sources, we need to take a reconciliation report. We need to take a reconciliation statement which creates the difference between the balance sheet as per accounting standard, as per Inds, and the reporting requirement as per Income Tax Act, in which there is an increase in the profit, decrease in the profit. And the second part is that in case of any conflict, ICDS preamble is mainly stating that in case of any conflict between the provisions for the Income Tax Act and the ICDS, the provision for the act shall prevail to the extent. Right, sir. Right, sir. Now again we are moving back to section 145(2), sir. Now again we are moving back to the section 145(2), sir. Sir, this section, this thing link with the point number 14, sir. Point number 14 of the tax audit report 3CB, sir. Sir, ICDS 2 will applicable inventory. ICDS 2 will applicable, sir, inventory. जितने भी provision है, sir, all the provisions of the inventory will applicable, sir. Method of valuation of closing stock employed in the previous year, sir. Please, can you tell me the differences between ICDS and Inds 2? Sure, sir. Can you please explain the differences, sir, between ICDS and the Inds? Yes, sir. I am taking you the differences. Between क्या? Sir, most of the provision are same. मैं क्या बोल रहा हूं? Most of the provisions of the Income Tax Act and the ICDS 2 is equivalent to the Inds 2, but the challenge is there from the valuation perspective, sir. What they say, sir? They say, sir, mostly they say that including all taxes, whether refundable or non-refundable, but in as per Inds, excluding refundable taxes. In Inds, we do not include the taxes which we get refundable by the taxation authorities. The second main point, sir, the main difference is because the Inds, the whole concept of the Inds, sir, is making on the fair value basis, sir. We need to clear this is a very important point, sir. All the concept of the ICDS is making on the basis of the fair values. And all the concept of the income tax is making basis of the historical cost, sir. For example, sir. For example, a very simple case, sir. I purchased rupees 20,000 raw material for manufacturing from you. I have purchased 20,000 rupees raw material from you, sir. But the payment term is that I will pay the amount after 2 years. I will pay the amount of 20,000 rupees from 2 years from onwards. What does India says? India says, please consider the time value of money. Please consider the time value of money. India say one thing: if I will pay the amount at right now, if I will need to pay the amount right now, then what will be the actual cash price that I need to pay? I am saying that, sir, simple rupees 18,000 rupees. Let's over. Sir, simple as sir. I need to pay only rupees 18,000 rupees. Just a second, sir. I need to pay only 18,000 rupees. Or, for example, sir, you say, sir, you are my friend. आप मेरे दोस्त हो, sir. I have not charged you anything extra. I will not charge you anything extra. You can pay me 20,000 rupees after 2 years. You can pay me 20,000 rupees after 2 years. Then not an issue. I say, sir, what is the cash price if I pay right now? I am saying, sir, 20,000 same. There is a no difference. What does India say, sir? India say, please calculate the present value, sir. India's 2 say, please calculate the present value. The amount that we will remit is 20,000 rupees. That the amount I will pay you is 20,000 rupees after 2 years. What will be the amount at right now? Because sir, the amount is the present value of money. The supplier gives me the financial arrangement. The supplier gives me the financial arrangement. Although the arrangement is notional, it is not real. Whole India is making on the concept of the notional. Whole India is making on the concept of the fair value. The amount 20,000 that we need to pay is not right now, is after 2 years. Suppose there is a market rate of interest of 10% for the 2 years. I approximately, for example, calculate the value of the 18,000 rupees, for example. So the present value of rupees 20,000 by the present value factor of 10%. So for example, it will come to 18,000 rupees. Now what will happen? The happen is that, sir, in ICDS, the value of raw material will be shown as the 20,000 rupees, because there is the no concept of the present value. There is no concept of the deferred in that ICDS. But if we see the balance sheet, if we see the India's balance sheet, sir, we see the inventory, the raw material amount is of 18,000 rupees, sir. This is the difference between the ICDS 2 and the Indias 2. So while making the tax audit report, we need to consider this, and we need to make the adjustment in the point number 13E of the form 3CD, and also the amount in the computation of the income tax. Sir, what will happen? Sir, what will happen to the 2,000 rupees? Sir, 2,000 rupees gaye kahan? 2,000 rupees, where the 2,000 gone? India's 2 simply state that, for example, the entry, the accounting entry day 1, accounting entry only. Entry is that, sir, inventory, we have come. We have book inventory account debit 18,000. 2, creditors 18,000 on the day 1. Now the, sir, India's 2 state that the standard says that, what is the contract period? Sir, 2 years. Sir, what is the contract period? 2 years. Please attribute the difference between 20,000 and 80,000. That is 2,000 rupees equally as a finance cost. According to financial statement. Then what will happen at the end of year 1? At the end of year 1, there is a 1,000 extra entry terms as a finance cost in the P&L. Finance cost account debit 1,000 rupees. सर यहाँ पर फाइनेंस कॉस्ट आ जाएगी 1,000 rupees 2. इससे क्या हो जाएगा सर? What will happen? 1,000 rupees, our liability is increased, sir, because we need to pay 1,000 rupees finance cost to the creditor. This is also a notional entry. 1,000 rupees as the creditor. The amount in the balance sheet is 19,000 rupees. Now in the year 2, again finance cost 1,000 will debit to 1,000 also credit. The 20,000 rupees is there, and when the time of payment, creditors account debit to bank account 20,000. Sir, what do you do in the ICDS, sir? What is the impact in the ICDS? Because, sir, we have charged expenses as a finance cost 2,000 rupees over the 2 years. In Income Tax Act, there is not a chargeable expenses related to the finance cost, because that is not allowable as per income tax, and also that is not allowable as per ICDS. So sir, in the year 1 also there is a increase in the profit of rupees 1000, because in computation of income of the year 1, rupees 1000 the finance cost we are debited shall be added back to the profit, because this is not a allowable deduction as per ICDS. And also sir, in the year 2, rupees 1000 is also added back to the income and also reported as an increase in the profit of 1000 rupees as per ICDS. 2, this is the change, sir. I am showing you a very simple amount, sir, but the impact is really huge, really unimaginable, really unthinkable, sir. Now, sir, the major difference of the ICDS, sir. Sir, companies, sir, why the ICDS क्यों बना, sir? Why the ICDS came to the picture? Because sir, everybody want to avoid tax. Everybody want to avoid tax. Everybody want to pay low income tax. Everybody want to pay low income tax. When we came to the method of valuation, sir, how we can value inventory, sir? How we can value inventory? We have two methods. One is FIFO. Second is LIFO. Not allowed, sir. LIFO is not allowed. Second is weighted average cost method, WAC. And the term there is called is the measurement techniques. Measurement techniques. We have two measurement technique: standard cost method and also the retail methods. So same in line with the Ind AS 2, same in line with the ICDS 2. Now I am telling you the difference between Ind AS and ICDS. I am telling you the difference between Ind AS and ICDS. This is the wording of the Ind AS 2, sir. This is Ind AS 2, sir. Please see, sir, the paragraph number 25, sir. Paragraph number 25. The cost of the inventories, other than those, I am assuming that you have a well-versed knowledge, you have a good knowledge about the Ind AS. I am assuming that, sir, you have a good knowledge about the Ind AS, because if we don't have a knowledge of the Ind AS, we cannot able to think about applicability of the ICDS even a single %, because what does ICDS do? ICDS do the differences between Ind AS and as per income tax. This is the adjustment, sir, according to the books of accounts and as per income tax sex, and ICDS play a very important role, sir. Very important observation, sir. Very important observation. Each and every line is important, sir. Each and every line is thinkable. Each and every line is like a wonder. The company basis, the company policies, the company profitability, the company trust is lined with the guidance of the standards, sir. Guidance of the standards, sir. The cost of the inventory other than those in the para 23 shall be assigned by using FIFO method, sir. We have already told that we have a FIFO method and a WAC. Sir, this is very important. An entity shall use the same cost formula. An entity shall use the same cost formula for all inventory having a similar nature and use. Having a similar nature and use to the inventory. For inventory with a different nature or use, different cost formula may be justified, sir. What does mean the different nature of use? Different nature of use means the entity shall use the same cost formula for all inventory having a similar nature or use. For example, sir, I am having the factory of the chips, of the Lays, of the water bottle. One of my manufacturing plant is there in the Hyderabad, and another of my manufacturing plant is there in Bombay. Nature is to make the bottles. The nature is same, sir. The plant use is to make the bottles. So what is the use of the bottle, sir? The use of the bottle is to sell, sir. Sir, what is the difference, sir? The nature and the use of the bottle is different, sir, because, sir, I have a pan-India supply. I need to make a different manufacturing plant. For example, if I am choosing the inventory valuation method, FIFO on the Bombay plant, and your company, your plant had said that, sir, no, sir, I will use the method WAC for the Hyderabad plant. Can I allow to do that as per NDS? The answer is no, no, unless we have a different nature of, unless we have a different nature or unless we have a different use, we cannot adopt different cost formulas methods. But sir, what does ICDS say, sir? What does ICDS say? This is different thing, sir. What does ICDS say? This is different thing. Sir, this is ICDS 2. This is ICDS 2 inventory, sir. This is the ICDS 2 inventory, valuation of inventory. I am going to the ICDS 2 and the method of valuation, I am saying that this is completely same. This is completely same. I mean, this is things, sir. This is things, sir. Kindly compare the para 16. Kindly compare the para 16 and para 25, sir. In para 16, the cost of inventory other than the inventory dealt with the paragraph number 13 shall be assigned using the fee for weight. Same thing, sir. This is different, sir. The formula used shall reflect the fairest possible appropriation to the cost incurred in bringing the inventory to their present location and the condition, sir. This is the difference, sir. This is the difference. In income tax act, if management want, because who are we as a tax auditor as challengeable? Who are the tax authority that can challenge, sir, to the different cost formula? Company manipulates the things. For example, they calculate the cost under using the FIFO or WAC. They are calculating the cost under the FIFO and the WAC. Sir, we also, we absolutely know that there can be a very much difference as per NDS and as per ICDS if different cost formulas is used, because as per NDS, we cannot change. We cannot change the cost formulas of Hyderabad and Bombay plant, but income tax sector, while calculating the income from the PGBP or IFOS, while implementing the ICDS 2, if management want, they can change the cost formula of any of the plant by taking the advantage of paragraph number 16 of the ICDS 2. But take care, sir. The main thing is that the formula used shall reflect the fairest possible appropriation to the cost incurred in bringing the inventory to their present location and conditions. This is the single ICDS inventory, sir. If I am talking if I will talk the each and individual point, sir, it is impossible to complete even the inventory part in 2 hours, sir. This is the major two. This is the major two differences. Major three differences according to inventories as per ICDS 2 and as per NDS 2. So what are the three differences? First, I'll tell that cost formula. Second is the deferred finance cost. Third, I am telling you main difference is the inclusive of the GST, inclusive of the tax according to ICDS 2. Sir, point number 14, what does say, sir? Point number 14, sir, from 3CD, sir, as a quality reviewer board, we need to think about that. And as per the booklet issued by the major non-compliances by the taxation auditing quality review board is that, see the, in case of deviation, please see the point number B. In case of deviation from the method of valuation prescribed under section 145A and the effect thereof on the profit and loss, please furnish. Sir, this is the thing, sir. This is the thing, sir. Is we are reporting to that thing, sir. Sir, क्या हम ये चीज report कर रहे हैं? If we are not reporting the things in that thing, sir, we are in a very bad situation, sir. As a quality reviewer, sir, you need to think, you need to see the point number 14 very, very carefully with respect to its financial statement, which is prepared as per NDS. Sir, what is the shortcut, sir? Please tell me, what is the shortcut? There is a simple shortcut, sir. Technically, there will be no differences. Technically, there will be no differences because we are taking sale as inclusive of GST, taking inventory as an inclusive of GST, taking purchase as an inclusive of GST. Sir, do you know one thing? Do you know one thing? Why we add back GST as per 43B while computing the return of income? Sir, GST add back क्यों हो रहा है sir? If you think, sir, GST is added back to the return of income to the computation if it is not paid before the due date of filing date of return. Sir, if you see the financial statement of any entity which is there as per AS or as per Ind AS, do you see the GST amount in the debit of the P&L? Please think, members. Do you see any amount of the GST which is debited in the P&L account? Because when you start taking the computation of income tax under PGBP, the first part is the profit before tax. Profit before tax, the amount of profit before tax is as per Ind AS, is as per the books of account profit, and we do the adjustment of addition, deletion, 43B, depreciation, gratuity, enhanced compensation, many of the things that we do, sir. Why we are adding back the GST if we not pay is directly linked with the section 145A. Sir, we need to mention as a taxation quality review board, as a quality reviewer, or as a preparer that my assessee follows a exclusive method of accounting. That means we have not included any amount of tax on sale, purchase, and the inventory which is subsequent refundable due to the nature of the Ind AS. But there is no deviation, there is no differences. Technically there is an increase in profit, sometimes technically there is a decrease in profit, and eventually the increase in profit and the decrease in profit will get automatically set off. So there is no increase in profit and decrease in profit. That thing we need to mention, sir. The thing we need to mention in case of the point number 14 and in case of the point number 13F when we say the valuation of the inventory in that case, sir. Coming about the ICDS 1, sir, accounting policies. Great, sir. Great ICDS, sir. Sir, this is the ICDS of the accounting policies. Here is the ICDS 1, sir, accounting policy. Same thing is that, sir. Same thing is there. We have a three fundamental assumption as we are there in the AS, as we are there in the framework for the Ind AS, and also as per Ind AS 1, going concern, consistency, and accrual, sir. We have not touch upon that. So the main issue is that only this paragraph number 4, sir. Accounting policy adopted by a person shall be such so as to represent a true and fair view of the state of affairs and income of the business, profession, vocation. For the purpose, the treatment and presentation of transaction and event shall be governed by their substance and not merely by their legal form. This is same as per Ind AS, sir. What does it change? The major change is that there is no concept of materiality in ICDS 1. There is no concept of materiality in ICDS 1. There is no concept of prudence in ICDS 1. Please, members, please take care. There is no concept of the prudence in ICDS 1, and there is no concept of the materiality in ICDS 1, sir. Second point is very, very important. We cannot book any of the provision, any of the losses in whole of the Income Tax Act unless the act or unless the any other ICDS will tell कि सर आप खर्चा बुक कर लो, सर आप expenses बुक कर लो. Otherwise, sir, if अगर कहीं नहीं लिखा हुआ, if there is no mention about the any provision, if there is no mention about the any M2M loss, we cannot book any provision because the concept of the prudence is eliminated in the ICDS 1. This is the main difference between ICDS 1 and the Ind AS 1, sir. And this is the part of the disclosure which we need to give mandatorily in the tax audit report, sir. Now ICDS 1 is complete, ICDS 2 is complete. The main difference is ICDS 3, sir. Main difference is ICDS 3 construction contract, sir. What is the difference? Sir, this is game changer for the real estate developer. This ICDS is a game changer for the real estate developer. Sir, मर गए सबके सभी real estate developer मर गए because the corresponding ICDS, because the correspondence NDS is NDS 115. Revenue from contract with customer. This NDS is totally different from the ICDS 3 and the ICDS 4, sir. ICDS 3 is related to the construction contract and ICDS 4 is related to the revenue, and NDS 115 is the mixture of the ICDS 3 and the ICDS 4. Means NDS 115 takes the construction contract as well as the recognition of the revenue part. NDS 115 prescribe the 5 model concepts, sir. NDS 115, sir, prescribe the 5 model concept. Concept number 1, identify the point number 1, step number 1, identify the contract. Step number 2, sir, identify the obligations. कितनी obligation है सर कॉन्ट्रैक्ट के अंदर. स्टेप नंबर 3, डिटरमाइन द ट्रांजेक्शन प्राइस. स्टेप नंबर 4, सर, allocate the transaction price to the obligations. Step number 5, sir, recognize revenue at a point in time, means at immediate level, or at over the time, means at the accrual basis over the time, not at the point in time, over the times. Now, sir, ICDS 3 clearly state about the, if you are involved in any of the construction contract as per ICDS 3, the method of revenue recognition is basis on the percentage completion method. This is mandatory, sir. In ICDS 3, percentage completion method is mandatory, whereas NDS doesn't mandate the percentage completion method, sir. This will change to the amount of the revenue by the numerous things, sir, by the number of things, sir. Because if in NDS, our real estate developer is estimating the amount of revenue of any different method, for example, milestone method, for example, any of the billing method, for example, any of the number of hour method, number of things method, sir, this is not applicable in case of the income tax. While computing income as per the Income Tax Act, percentage completion method is allowed. If you see the reports of the big corporate groups which are dealing in the real estate developer, we may not find the how they are paying the income tax to the income tax department, because the revenue figure, because there is the sale figure is computed as per NDS. But if by chance you have access to the tax audit report, you will see the very big difference while computing the income as per ICDS, because they have taken the percentage completion method mandatory, while NDS there is no mandatory requirement of the percentage completion method. This is a very important point we get to know, sir. Second, sir, while calculating the amount of the contract revenue, sir, retention money is also be included while calculating the amount of the revenue, sir. Retention money is also be there while calculating the amount of revenue as per ICDS. But whereas as per NDS, whereas as per accounting standard, the retention money amount shall be taken back to as a revenue only when there is a ultimately certainty that the condition have been complied with, that all the guarantees have been complied with, and we have fulfilled all the condition, and there is no chance that the customer can take my money back. on that case, we will book the income or revenue as per India's. But sir, Income Tax Act says, doesn't matter, sir. You have given the retention to anybody. You have strategically given the retention money to anybody. होता क्या था सर, एक सेकंड एग्जांपल हिंदी में लूंगा. मेरे पास आ जाए 100 करोड़ सर. मैं क्या करता हूं सर, उसको बोलता हूं जानबूझ के, प्लीज टेक 50 करोड़ एज अ रिटेंशन मनी बिकॉज आई डू नॉट वांट टू पे टैक्स. I do not want to pay tax because sir, I am stating to the department, I am stating with my financial reporting framework that there is some dispute going in between me and my customer, and that will take 2 to 3 years to solve. On that case, sir, I will not book the revenue as per India's 115 because only I can book the revenue when there is a certainty ultimately of the collection. But as per ICDS, sir, if I see the contract revenue, यहाँ पर सर आप देख लीजिए, if I see the contract revenue shall comprise of the initial amount of revenue agreed in the contract, including the retention, sir, including the retention money. This is the big change. This is the big change in the ICDS as compared to India's. This is that retention money is also included as a part of the contract revenue on the initial stages. While as per India's and as per accounting standard, there may be a probability that it will not include, and that will create a difference between income as per India's and as per ICDS, and we need to take account that income to the tax audit and while computation of the income tax. So this is also the difference of ICDS 3, sir. Again, there is a major difference that if we have a service contract, and if we have a service contract, please tell me, sir, it's a service contract. It's not a real estate contract. It's only a service contract. We have only a service contract, sir. And if for example, sir, contract starts on 1st March 2024. Service contract means maintenance contract, and completion of contract is due on 30th April 2024. 60 days. And for example, the cost, the revenue of the contract that we will take from the customer is 60,000, is rupees 60,000 for whole of the contract, sir. And the related expenditure for 2 months is of 10,000 rupees. Sir, what we can do in the financial statement as per NDS? Sir, we can do very simple things, sir. We can do, because sir, we are making the financial statement according to the accrual method, and according to India's 115, all the conditions have been satisfied and we can recognize the revenue over the point in time. Simple as accrual basis, the revenue will be 30,000, sir, and the expenditure will be 5,000, sir, and the remaining profit will be 25,000, sir. This is very simple, sir. But no, sir, in ICDS 4, revenue recognition, and in ICDS 3, there is a concept called if we are dealing in a service contract, and the time required to get the service contract completed is less than the 90 days, the income shall be taxed in the year when the contract has been completed. The income shall be taxed in the year when the project is completed. So, sir, there is a ICDS requirement from this assessment year. The project is not completed. For AY 24-25, the project is not completed. The project is completed in the AY 25-26, sir. So, the income will be taxed on to AY 25-26, not in the AY 24, 25. What you can do, sir? You can decrease the profit to you can decrease the profit 30,000 because that is not allowed income as per ICDS, and the expenditure is also reversed back, reverse add. So 25,000, there is an increase in the profit due to the ICDS requirement. This is also the very, very important requirements of the ICDS. Now, sir, I am going to the ICDS 5 tangible fixed assets, sir. Now, sir, I will go to the ICDS 5 tangible fixed assets, sir. Is Rohanji, is my voice is there? Audible?
Yes, sir. Yes, sir. Your voice is absolutely clear, sir.
Okay, great. So now I move forward to the ICDS 5. Very important ICDS. Tangible fixed asset. So please remember, in income tax, in ICDS, the name is the tangible fixed asset. But what we are following the INDS is INDS 16 PPE, property, plant and equipment, sir. Just to give you the brief thing, if you doing the audit of the non-corporate, means any partnership firm, proprietorship, trust, societies, while making the financial statement, if you are using the word fixed asset, you are doing a more blunder, sir. You are doing a more blunder, because the financial statement is prepared as per NDS, as per accounting standard, not as per Income Tax Act, not as per ICDS. When we make a computation, when we make a tax audit, we can adjust the amount according to the Income Tax Act and according to the ICDS. Right, sir? Right. The main difference, yes, I will forget the difference, is the construction contract. Main difference, blunder, sir. Main difference in ICDS 3, construction contract. What does ICDS 3 says? ICDS 3 construction contract says, while calculating the contract cost, means आपने खर्चा कितना किया उस कॉन्ट्रैक्ट को कंप्लीट करने के लिए, what do you have spent, what the amount of expenditure do you have spent for completing the contract to earn the contract revenue. Please include the interest charges. Very important, please include the interest charges. If we are means if we are taking a loan from bank, please, if we taken a loan from the bank to complete our contract, many of the entities in India, 90% of the entities in India is taking loan from the financial institution, loan from the bank to complete their construction contract. Means majority of the real estate corporate groups will take the loan to complete their project as a construction contract. Now, what does ICDS 3 says? How they can say? I don't know what they are thinking. I don't know how Government of India can incorporate the concept onto that. The ICDS 3 says, if there is any interest, any interest occurring from the loan that we take to complete our construction contract, they shall form part of the contract cost, sir. They shall form part of the contract cost. This is telling by the ICDS 3. And what does India say? India say expense it. There is no logic of the interest cost for capitalizing as a part of contract cost. Just expense it when we incur. That is the fundamental thing, sir. But ICDS say the different thing. Now, I'll tell you one thing also, sir. Please don't be kept folding our eyes only just seeing the provisions of the ICDS. We also need to see the provision of the Income Tax Act also. We also need to see the provisions of the Income Tax Act also. Income Tax Act says, if we take the loan, Income Tax Act says only those interest can be capitalized, on the capital asset that takes substantial period of time to get ready, for their intended use, for their intended use. Is I am clear? Is I am clear? The construction contract, we are only a service agent. We are only a servicing agency because we are making the construction not for the sale. We are making the construction not for the sale because we are getting the service contract as a construction contract. The asset which we are making is not capital asset, so all the interest incurred while relating to bank shall be expense of in the year of the occurrence. This is the example where ICDS say different and the Income Tax Act say different, but sir, provisions of the Income Tax Act will prevail over the ICDS. This is a very important thing, sir. Now, I'm going back to the ICDS 5 tangible fixed assets. The first example, the first conflict between the financial statement as per Ind AS and ICDS 5th is the recognition of the initial cost. Means as per Ind AS, the dismantling charges, the restoration charges. For example, sir, हमने एक plant लगाया यहाँ पर. We have taken a plant and we have incorporated the plant. There is some environmental regulation. There is something environmental rule which stipulate that after the 20 year, after the completion of the life of the asset, we need to restore the building. We need to restore the place as it is, as we are taking right now, sir. What does India say? India says that the initial estimate of the expenditure that we will need to take after 20 years, the initial estimate of the amount that we need to pay 20 years back, 20 years after, will also taken into the account of the cost of the tangible fixed asset, while in ICDS there is no concept of that thing, sir. What will happen, sir? The happen is that because we know that Ind AS is make on the fair value, the Ind AS is makes on the present value. What we do? We do simple things, sir. We do very simple things, sir. For example, the initial estimate of the expenditure after 20 years is right now 2 crore. 2 crore. That we will spend 2 crore after 20 years, right? And sir, we also know all the things is carrying at the present value. Sir, is we are spending 2 crore right now? Simple question. Is we spending 2 crore right now? The answer is no. We will spend 2 crore after 20 years. That too also the initial estimate. And the rate, the incremental borrowing rate, the market rate of interest, for example, is 8%. Then we need to take the present value of the 2 crore of the 20 years into 8% while arriving the value of right for the year 1, for the year 0. So that amount shall be added to the cost of the property, plant, equipment. Sir, please see, if we think that always, that on the initial recognition, always the value, the carrying amount of the tangible fixed asset is same as per Income Tax Act and as per Companies Act, is not practically possible, sir. इस केस के अंदर तो कभी मैच ही नहीं कर पाएगा. That will never match because of the dismantling charges added back to the cost of the PPE. And in income tax, there is no concept of the dismantling charges. There is no concept of the present value of money, and there is also the difference between ICDS 10 provision as compared to the Ind AS 37 अपना provision, contingent asset and contingent liabilities. The also difference between the carrying amount is the foreign exchange. The difference between the carrying amount in the foreign exchange as per ICDS, sir. There is a one section called Income Tax 43CA, and the rule is 115A of the Income Tax 1961. What does the rule say? if we purchase, if we acquire the any fixed asset from outside the country, if we acquire the fixed asset from outside the country, from the loan given by the foreign bank, if we taken a foreign currency loan and purchase that asset from the foreign, then please think the exchange differences, unless they are actually realized, shall be added back or reduced from the cost of the property, plant, equipment, cost from the tangible fixed assets. And while the India say that, India's 21 foreign exchange say that if there is any foreign exchange, now the foreign exchange shall be divided into two parts: monetary asset, non-monetary asset. Now we have no left the time to explain what is monetary asset, what is non-monetary asset. If there is any differences, then it shall going to be expensed in the profit and loss account. Wherever as per ICDS, wherever as per income tax, it is stated that only in the one case, when we taken a foreign currency loan and acquired the fixed asset from outside, from foreign, not in India. If we are taking a foreign currency loan and if we purchase the asset from India, then this provision will not apply. Then the ICDS and INDS are in the same line. But sir, if we take a foreign currency loan and acquire the asset from the foreign, then any of the exchange difference till the realization shall be added or reduced as a cost of the tangible fixed assets. Another major difference from ICDS that, sir, we always know that in NDS or in AS, the depreciation shall start, the capitalization will suspend when the asset is available for use. Sir, we all know that. Yes or no? Yes, sir. Sir, in AS or in NDS, the capitalization will suspend. The depreciation will start immediately when the asset is available for use. Sir, whereas in income tax, the ICDS say that the depreciation will start when the asset is put to use, when the asset finally start commercial production, when the asset is actually put to use, not available for use. Sir, this is simple. We all know that. So the main question is that the expenditure, the maintenance charges, the subsequent charges which is incurred between when the asset is available for use and when the asset is actually put to use shall also be capitalized as a part of the cost of the tangible fixed asset. This also creates the mismatch of the initial amount, carrying amount of the tangible fixed asset as per ICDS and as per NDS or as per AS. Sir, what does about the borrowing cost? What does about the borrowing cost, sir? As per NDS, the borrowing cost shall suspend when the asset is available for use. But in income tax, the borrowing cost will continue to be charged as a part of the cost of the asset till the asset is put to use. Sir, you may see the number of differences, the number of adjustment, the number of entries that will need to be passed in the computation of income and in the tax audit report. Sir, this is a very interesting thing, sir. Again, the major change in the ICDS 5 for tangible fixed asset is the exchange of the asset. Very important, sir. Exchange of the asset. In case of India 16, when we exchange our asset, means we have asset number B, and you have asset number A. Sir, we just exchange our asset, means मेरी asset आप ले लो, आपकी asset मुझे ले लो. Sir, now the accounting entry, what will be the accounting entry? Sir, the accounting entry as per NDS is that we need to take care जो asset मेरे पास आई, the asset which I am receiving, which asset I am receiving is asset number A of you. The value of that asset shall be the value of that asset shall be determined according to the asset which I given up, means in Inds As the fair value of the asset acquired, shall be calculated on the basis of the fair value of the asset given up, and in ICDS the fair value of the asset acquired shall be taken on the basis of the fair value of the asset taken. For example, sir, I am just giving you a very simple example, then you can understand it. I have a asset A in the balance sheet which is carrying amount is 5,000 rupees, and you have a asset in your balance sheet which is asset B having a carrying amount of 6,000. The fair value of asset A is 8,000 and the fair value of asset B is 5,000. Now I am exchanging the asset. What will be the accounting entry in the books of Karthik? For example, what will be the accounting entry in the books of Karthik according to the Inds As 16? The asset is derecognized, so I eliminate asset A from my balance sheet. Amount is 5. What is the amount? 5,000 rupees. What does Inds As say? Sir, when you taking the asset, which asset I am taking? Sir, I am taking the asset number B. Please recognize the asset number B in the books of account. Sir, what is the value? The Inds As says that the asset given up, the value shall be taken as the fair value of the asset given up. So I have given asset number A. The fair value is 8,000. So 8,000 is there. So I made a profit of 3,000 rupees. I made a profit of 3,000 rupees according to the Inds As. What does ICDS says? Sir, what does ICDS say? Same entry to asset A, derecognize 5,000. I have taken a asset number B. But sir, ICDS says that the fair value of the asset taken, shall be taken as a cost. I have taken the asset B. The fair value is 5,000. The 5,000 is there. I have made a no profit or loss in the income tax. So while making the computation, so please remember, I need to reverse the 3,000 rupees in the income tax in the computation of income, and also remember the carrying amount is also different. Sir. This is all about the ICDS 5, and now I am talking about the ICDS 6, that is foreign exchange. I am already talking about. Now let's coming about the next ICDS. We have very short of time, sir. I will at least take 5 to 10 minutes more to explain very relevant point, the ICDS. This is only an overview, sir. I hope I am able to justify the requirement. I hope I am able to rectify the things that we misplace. Please remember, if the amount is 0 in any of the thing, then disclosure according to the 13F shall be given. The disclosure according to the 13F shall be mandatory, need to be given. Again, government grant, very important ICDS, government grants. There is an amendment in the act. When the government grant ICDS came, the Finance Act 2015 have made amendment in the act according to the section 224, which define about the income. They have made amendment that if any entity is receiving the grant related to the depreciable asset, if any entity is receiving the grant related to the depreciable asset, they shall deduct the amount so received from the cost of the asset, sir. Means simple है sir, जो भी government grant मिलेगी related to the depreciable asset, It is mandatory. Only one option is there. It is mandatory to set off. It is mandatory to reduce the amount of the cost of the asset for the grant is been given. But sir, what does Inds 20 say? Inds 20 has a two options, sir. Inds 20, this is called the capital nature of the grant. In the concept of the government grant, according to the accounting standard, yeah, Inds, it includes the concession, it includes the forgiveness, it includes the government assistance, and it also includes the grant related to the capital nature or related to the revenue nature. If we receive any grant related to the revenue nature, we will need to do according to the profit and loss account, according to the Inds 20. But when it comes to capital nature, there is a difference between ICDS and Inds on that part. According, if we receive any grant related to the capital nature, means related to the depreciable asset, Inds gave us two options. Inds gave us two options for presentation. Inds gave two options for the presentation. One is same with the ICDS, that deduct the cost from the asset, then automatically depreciation will reduce. Second thing, second option they have given, that not to reduce the amount of the asset, not to reduce the amount of the asset, show the government in the side of the liability as a deferred government grant, and over the number of years of the depreciation of the asset, we shall amortize the deferred government grant as a income in the statement of profit and loss account, and ultimately the depreciation charge will high. If the entity is doing that type of presentation, that is not appreciable, that is not in the line with the ICDS. We need to take a stand back, we need to take reverse calculation, and we need to give the adjustments in the computation of income and disclosures and amount in the clause number 13 of the tax audit report. This is very important. Many of the clients, many of the entities doesn't know even that type of thing, that there is a difference between the presentation requirement, and all over the sudden the things will move on, go there and there, the profit amount will hamper on the spot, sir. Second, in ICDS, if we received the government grant, if we actually received the government grant, we need to take in that grant as a taxable amount. It does not matter whether we satisfy the condition, whether there is a reasonable assurance, whereas according to Inds 20, there is a condition that entities shall recognize government grant only and only when there is a reasonable assurance that the entity will receive government grant, and the condition attaching to the government is reasonably to be complied with. But in India, if we receive the government grant, it does not make a recognition criteria. No, only the government grant shall be recognized in India as per Inds 20 only when the condition attaching to the grant is reasonably expected to be complied with. But whereas as per ICDS, if we receive any single rupees of the government grant, if we received, means in ICDS, the taxability of government grant shall not be the date away from the actual receipt of the grant. Means the actual receipt of the grant is the last date for the recognition of the grant. If we receive the grant, we need to take that income as a chargeable to income tax, wherein ICDS, wherein India, there might be a condition that the government grant is not recognized. There is also a make a difference. Also, sir, there is a ICDS related to the securities, sir. Very important ICDS. Very important ICDS, sir. In financial instrument, we have a Inds 109 financial instrument. There is no comparison, there is no match between Inds 109 and ICDS 8 securities. The most memorable thing is that ICDS 8, sir, securities is only applicable. ICDS 8 securities is only applicable when we have a security as a stock in trade. When we having a security as a stock in trade, for example, equity share held as a stock in trade, debentures held as a stock in trade, preference share held as a stock in trade, how we can recognize the amount as per income tax as per ICDS? Sir, please remember, follow the principle of ICDS 8. Read with the section 145A. The main important thing is that we need to measure the, as per ICDS, we need to measure the amount of security held as a stock in trade according to the cost or NRV, whichever is lower on a category wise. Means category wise, besides as per India's or as per accounting standard, we need to see each and every investment which is having as a stock in trade as a script wise. Script means individual wise. For example, sir, we have these things. Let's just conclude with 2 minutes. Just a second, sir. Yeah. Please see, sir. Please see, sir. See. Para 9 of ICDS 8 on security requires security held as a stock in trade shall be valued at cost, initially recognized, or NRV at the end of the previous year, whichever is lower. Para 10 of part A of ICDS 8 require the said exercise to be carried out category wise. Category wise, sir. Category wise means share is total number of equity share is taken as this, and total number of debt security is taken as this. Category wise means total cost or total NRV, whichever is lower, we will make ICD's value as 535. Whereas in the financial statement, sir, it is valued individually. It is valued item by item basis. For example, 100 or 75, whichever is lower, sir, 75. Then 75 is the consideration according to the Inds. 120 or 150, whichever is lower, 120 is there. 140 or 120, whichever is lower, sir, 120 is there. Something, the value is 505 according to the financial reporting, and the value is of category wise according to the ICDS. So there is a difference of INR rupees 30. There is a difference of the INR rupees 30 according to the ICDS 8. You need to remember only one thing. In ICDS 8, the valuation of cost or NRV shall be made at the category wise, and in accordance with the financial reporting framework, the valuation shall be made on the item by item basis, script basis. That will create huge impact on the valuations of the investment. Only held as a stock in trade only, sir, baki nahi, held as a stock in trade as a inventory. Last but not the least, you will find many adjustment of the ICDS related to the leases. Why? Sir, because India's 116 is there, right of use asset is there, lease liability is there. There is no concept in the income tax sector. Sir, please remember, this is the adjustment related to the return of the income as per Income Tax Act, because that amount of deduction is not allowed according to the Income Tax Act, not as per ICDS. Not as per ICDS. Only that amount shall be shown under the column. Which column? Under the column, sir, this column. Only those amounts shall be shown under this column, this increase or decrease in profit. If it is fall in the 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 only, sir. Leases is not there. Prior period error is not there. Any change, any accounting change in the policy is not there. Kindly please don't overflow the information in that part, because this is not relevant to the ICDS. This is relevant to the computation of income tax. So I broadly taken all the things, broadly enrich your mind that how this be applicable, and it is very important to understand each and every concept of the ICDS linked with the NDS and also linked with the AS. I only tell you the brief concept, sir, because the NDS financial is according to the fair value, sir. Even though, sir, revenue cannot be matched, I challenge that revenue cannot be matched according to the ICDS, sir, because there is a lot of differences as per India's 115, as per India's 109, as per India's 1, as per India's 16, as per India's 20, as per India's 23. Sir, there is a lot of differences between NDS and ICDS. I request by the fold hand, please study the requirement very carefully. Please read the guidance note on tax audit by the ICI. Please read the taxation auditing quality review, the study material that will guide. And also, please read the technical guide about the ICDS and also about the FAQs issued by the CBDT on the ICDS. I believe, sir, you will give lot of knowledge. I tried my best, sir, to enrich, sir. If any mistake happen, I forgive, sir. मुझे माफ करना, sir. And I really like to thank the Taxation Auditing Quality Review Board, TAQRB, Sanjay sir, and Vice Chairman of the Board, Anuj Goyal sir, and the moderator, Shri Rohan Sharma ji, and all the support team, tax team, Maurya ji, and Secretary ma'am, and Dharmender sir for giving me that wonderful opportunity. And I also like to thank the participant for their careful listening and lovable hearing. Thank you so much, sir. Thank you, sir. Over to Rohan ji.
Thank you, Karthik ji. Thank you, Karthik ji, for your words of wisdom. I hope and I believe that listeners to this webinar might have gained an insight into what are the practical challenges when it comes to you reconciling the books of accounts as per Income Tax Act and the books of accounts as per Indian accounting standards. These are very practical and imminent challenges that the young professionals and even the senior professionals face when they conduct tax audit as per Income Tax Act 1961. I thank you for your words of wisdom, for your sharing your knowledge and letting the people know, the professional body know that these are the challenges and how to navigate those challenges when they execute their pro- their projects. I now open the floor to the participants to ask their questions if they have any.
रोहन सर, अगर
Karthik ji, do you have
साइट पे क्वेश्चन आया होगा तो वो आप ले लें
हाँ
एक
हाँ
बार।
वही Karthik ji, we have a question from Sanjeev Mehrotra ji.
Okay, sir.
He asks, in case few source of income with accrued interest on FD, other income as cash basis, shall it be considered as hybrid? Is it allowed in
Sir,
the past
see,
by AO?
hybrid model is not allowed as per Income Tax Act, while amendment in the Finance Act 1995. And there is also a Supreme Court ruling to that thing, 2 or 3 different type of ruling, and this is equally stated very clearly in the guidance note on the ICDS technical guide that hybrid model cannot be used by the any assessee in any case. Only in one case it can be used, only in one case, when we have a different business. When we have a different business of the same entity, we can use the different type of model. Otherwise, hybrid model of accounting is not allowed. If we read the section 145A, the change behind to change is that the change is not in 2017, Rohanji. The change will take back in the 1995. They have take that regularly employed by the assessee method of accounting, either cash or mercantile. So hybrid model is not at all allowed, sir. Hopefully I answered the question, sir. If there is any question, sir, you can ask me over WhatsApp, over the.
I believe Sanjeev Mehrotra ji got his answer. Again, we have a question from BS Venkatesh. One more question, Venkatesh ji. He asks, leases, we do not have to take we do not have to make any adjustment in the IoT return and tax audit return of the lessee
See,
as
sir,
far as leases are concerned.
I understand the question, and hopefully I answered that question before 5 minutes before. I already stated that there is a no ICDS related to the leases right now. There is no ICDS. I know there are differences between the Income Tax Act and as per the accounting standard Ind AS 116 related to the computation of income. It will show as an adjustment. What will like? It will added back as a amortization of ROU asset in the income tax return, and also adding back the finance cost interest on the lease liability added back into the return of income, and less the expenses with the rent which is actually paid by the lessee. This is the relevant provision. But sir, this is not linked with any ICDS. Do not make any adjustment in the tax audit related to this lease concept. Only make the adjustment in the income tax return computation.
Also, Venkatesh ji, I would like to share my knowledge on this as well. So far, the ownership of the asset is with the assessee. He can claim depreciation on that. But if the assessee has leased that asset from anybody, then he's entitled to a deduction or disallowance. Allowance of rental expenditure in his in the computation of his total income. The concept of computation or making ROU assets and lease liability is different from how we can compute the total taxable income under Income Tax Act 1961.
Correct. The only shortcut is that, sir, there is no link with the ICDS of the leases.
I believe we do not have any further questions from the participant. So I would like to take time to thank CA Sanjay Agarwal ji, CA Anuj Goyal ji, CA Karthik Jindal ji for their valuable time and feedback and their knowledge sharing on this important and crucial topic, as the tax audit period is around the corner. And I would also like to thank all the participants for joining in and taking part in this webinar and listening to Mr. CA Karthik Jindal ji. Thank you, everyone. Thank you so much.
Thank you, sir. Thank you, sir.
Thank you and namaskar.